Introduction: The hidden cost of being right. There is a particular kind of silence that follows a bad investment. Not the silence of ignorance, not the silence of confusion, the silence of ego. You see the numbers. You know the thesis is breaking. The market is moving against you. The evidence is no longer supportive. And yet, instead of adjusting, you hesitate. Not because you lack intelligence, not because you lack information, but because selling would mean admitting something far more painful than financial loss. It would mean admitting you were wrong. And for many people, that is the true loss. We like to believe that financial decisions are rational, that markets are arenas of calculation, that investors weigh risk and reward objectively, then act accordingly. But if that were true, intelligent people would change their minds quickly when evidence shifts. They rarely do. Instead, they double down. They defend. They rationalize. They reinterpret data. They search for confirming opinions. They move goalposts. They increase exposure. And when asked why, they provide sophisticated arguments. The arguments are often coherent, sometimes even impressive, but beneath the logic lies something deeper: identity. The economist George Akerlof introduced a powerful framework known as identity economics. He argued that individuals do not act solely based on material incentives. They act according to who they believe they are. Identity is not decoration. It is motivation. People derive utility not just from outcomes, but from behaving in ways consistent with their self-image. If you see yourself as a disciplined investor, admitting a mistake threatens that identity. If you see yourself as visionary, exiting early feels like betrayal of that image. If you publicly predicted a trend, reversing course risks reputational damage. Money decisions are never just about money. They are about self-definition. When you buy an asset, you are not merely allocating capital. You are making a statement. I believe in this. I understand this. I am the kind of person who sees this opportunity. As exposure grows, identity fuses with position. The investment becomes part of your narrative. This is why losses feel personal, not because of the numerical decline, but because of what that decline implies about you. Markets do not just challenge portfolios, they challenge self-image. And the brain is designed to defend self-image. Psychology provides a concept called cognitive dissonance, the discomfort experienced when reality contradicts belief. In investing, dissonance emerges when outcomes challenge identity. You believed you were early. You believed you were insightful. You believed you saw what others missed. Now the market disagrees. Admitting error would restore alignment with reality, but disrupt alignment with identity. And so the mind chooses preservation. It searches for alternative explanations. The market is irrational, short-term noise. They don't understand the fundamentals. This will recover. These explanations are not always false. Markets are volatile. Mispricings exist. Long-term theses can be correct despite short-term drawdowns. But the key question is motive. Are you holding because the thesis remains valid? Or because letting go feels like diminishing yourself? The difference is subtle and dangerous. Financial markets are not just systems of capital allocation. They are arenas of status. Performance signals competence. Forecasts signal intelligence. Gains reinforce identity. When someone becomes known for a particular view, bullish on technology, committed to real estate, loyal to value investing, that view becomes social identity. Changing positions publicly can feel like weakness. Doubling down feels like strength, even if doubling down increases risk. This is why intelligent investors sometimes stay wrong longer than they should. The smarter the individual, the more elaborate the defense. Intelligence becomes a tool of justification rather than adaptation. Sophisticated narratives are constructed. Data is selectively interpreted. Complex frameworks are deployed to defend a prior stance. The goal is not necessarily deception, it is preservation. Preservation of internal coherence. We underestimate how much we crave consistency. Consistency feels stable. Consistency feels safe. But markets reward flexibility. The paradox is sharp. The trait that protects your identity can undermine your wealth. Consider the sunk cost trap. Once time, money, and reputation are invested, walking away feels like a racing effort. Escalation of commitment follows. The deeper you go, the harder it becomes to exit. Not because exit is irrational, but because exit contradicts the story you have told yourself. The longer you defend a position, the more it becomes you. And abandoning it feels like self-diminishment. This is the hidden cost of being right. When being right becomes central to identity, adaptation becomes psychologically expensive. And markets evolve constantly. What was correct yesterday may be flawed today. If identity is rigid, capital suffers. If identity is flexible, capital survives. In this episode, we will explore the psychological architecture of ego in financial decision-making. We will examine how identity economics reshapes our understanding of risk. We will analyze why admitting mistakes feels dangerous, how status and pride influence portfolio decisions, why sunk costs intensify attachment, and how intelligence can paradoxically trap smart investors. Most importantly, we will ask, how can you detach identity from capital? Because wealth compounds most effectively in those who can say 3 words without ego resistance. I was wrong. Those words are simple, but in markets, they are revolutionary. The investor who can update beliefs without defending identity possesses an extraordinary advantage, not because they avoid mistakes, but because they refuse to become them. And once you see how deeply identity influences money decisions, you begin to understand something unsettling. Many financial battles are not against the market. They are against ourselves. Section 1. Identity Economics. The Framework. Traditional economics begins with a simple assumption. Individuals act to maximize utility. Utility is typically defined in material terms: income, consumption, wealth, security. People respond to incentives. They calculate costs and benefits. They pursue outcomes that improve their position. This framework is elegant. It explains markets efficiently. It predicts behavior under certain conditions, but it is incomplete because human beings do not only maximize money, they maximize meaning. This is where George Akerlof reshaped economic thinking. Along with Rachel Cranton, he developed what became known as identity economics, a theory arguing that economic behavior is deeply shaped by identity. According to Akerlof, individuals derive utility not only from material outcomes, but from acting in ways consistent with their sense of self. Identity is not a side variable, it is central. We do not simply ask, what pays the most? We ask, often unconsciously, what does someone like me do? That question changes everything. Identity as economic incentive. In identity economics, behavior is influenced by three layers. 1. Material incentives. 2. Social norms. 3. Self-concept. Traditional models emphasize the first. Identity economics integrates the latter two. Individuals belong to social categories, professional roles, cultural groups, ideological communities, investment tribes. Each category carries norms about how members are supposed to behave. A disciplined investor behaves differently from a bold visionary. A value investor thinks differently from a growth disruptor. A crypto maximalist interprets volatility differently from a skeptical traditionalist. These identities generate internal expectations. Acting in alignment with identity produces psychological reward. Acting against it produces discomfort. That discomfort can outweigh financial consequences. The self as utility function. Imagine an investor who publicly identifies as a long-term believer in a specific sector. If that sector declines, the rational response might be to reassess exposure. But reassessment creates identity tension. If they sell, what happens to the self-image of conviction? If they reduce exposure, does that signal doubt? If they change stance publicly, does that diminish credibility? The decision is no longer purely financial. It becomes existential. Akerlof's insight was that identity shapes perceived payoffs. The emotional cost of violating self-concept enters the decision matrix. Thus, holding a declining asset may produce higher identity utility than selling it, even if selling would improve financial utility. From the outside, this looks irrational. From inside the identity framework, it is consistent. Social categories and norm enforcement. Identity does not exist in isolation. It is reinforced socially. Financial communities operate like tribes. There are shared beliefs, favored language, respected authorities, and implicit norms. Within each tribe, behavior signals membership. If you are part of a growth investing community, skepticism about innovation may be discouraged. If you belong to a conservative capital preservation circle, high-risk speculation may be frowned upon. Deviation risks exclusion. And exclusion carries psychological cost. Thus, investors may maintain positions not only to protect internal self-image, but to preserve social alignment. Money decisions become acts of belonging. Markets as identity arenas. Financial markets are not neutral platforms. They are stages for identity expression. Your portfolio communicates something: risk tolerance, worldview, intellectual allegiance, confidence level, even political philosophy. An investor heavily concentrated in emerging technologies signals optimism about transformation. One focused on tangible assets signals skepticism of abstract valuation. These signals matter socially. When financial decisions communicate identity, changing them becomes symbolic. Selling is not merely reallocating capital, it is revising narrative. And narrative revision feels destabilizing. Why rational updating feels threatening? In theory, rational investors update beliefs when evidence changes. In practice, updating threatens coherence. Coherence is deeply valued by the brain. Internal consistency reduces anxiety. Stable identity creates psychological security. If new evidence contradicts prior conviction, updating requires admitting prior error. That admission weakens identity certainty. For some, especially those whose professional reputation is tied to financial forecasting, this threat is amplified. The cost of updating is not just private doubt, it may be public loss of credibility. Thus, investors sometimes prefer preserving consistency over maximizing returns, not because they misunderstand data, but because they value identity stability. The role of self-signaling. Identity also operates internally through self-signaling. We observe our own actions and infer who we are. If you consistently hold through volatility, you reinforce the identity of discipline. If you panic sell, you may perceive yourself as weak. Thus, behavior becomes a way to confirm internal narrative. Holding a losing investment can feel like proof of resilience. Exiting early can feel like surrender. The mind weighs these identity signals alongside financial data, often without awareness. Identity and escalation of commitment. Once identity fuses with decision, escalation becomes likely. Suppose an investor publicly endorses a specific thesis. They commit capital. They defend the position in discussions. Their reputation becomes partially linked to that stance. If evidence weakens, reducing exposure implies not only financial adjustment, but narrative retreat. Instead of retreating, many double down. Additional capital is deployed. More elaborate justifications are constructed. The position becomes a test of character. Identity economics explains this not as irrational stubbornness, but as identity preservation. When identity is at stake, escalation feels like integrity. Intelligence does not immunize. One might assume that sophisticated investors are less vulnerable. Often, the opposite occurs. The more articulate the individual, the more complex the rationalization. High intelligence enables nuanced defenses. Data can be selectively interpreted. Time horizons can be adjusted. Alternative frameworks can be invoked. The thesis evolves, but the identity remains protected. Intelligence becomes armor. Identity conflict and financial stress. Identity conflict generates stress. When market reality diverges sharply from personal narrative, cognitive strain intensifies. The investor faces two choices. 1. Update beliefs and revise identity. 2. Protect identity and reinterpret reality. The second path is psychologically easier in the short term, but financially costly in the long term. Repeated across markets and cycles, identity rigidity compounds error. The hidden structure of financial behavior. Identity economics reframes financial mistakes. Instead of asking, why didn't they see the data? We ask, what identity were they protecting? Were they defending competence, status, consistency, belonging, authority? Once identity becomes visible, behavior becomes more predictable. Investors rarely defend spreadsheets. They defend self-concept toward flexible identity. If identity shapes economic action, the solution is not eliminating identity. It is redefining it. Instead of identifying as the one who is always right, one might identify as the one who adapts. Instead of defining self-worth through prediction accuracy, define it through learning velocity. Identity is inevitable, but identity can be structured around flexibility rather than certainty. Akerlof's framework does not condemn identity. It reveals its power. Financial decisions are not detached calculations. They are reflections of who we believe we are. Understanding this changes the question from, what should I invest in? To, who am I becoming when I invest this way? That question is deeper and far more consequential. Because markets will challenge your portfolio repeatedly, but they will challenge your identity even more relentlessly. And unless you see how identity shapes incentives, you will continue believing you are optimizing wealth, when you may in fact be optimizing ego. Section 2. Ego protection and cognitive defense. If identity is the foundation, ego is the shield. Identity answers the question, who am I? Ego answers the question, how do I protect that image? In financial markets, ego protection is one of the most powerful and most invisible forces shaping behavior. It does not operate loudly. It does not announce itself. It disguises itself as logic, conviction, discipline, even courage. But at its core, ego protection is a defense mechanism. It activates when identity feels threatened. And nothing threatens identity faster than being wrong in public. The pain of being wrong. Losing money hurts, but being wrong hurts more. Money loss is external. Being wrong is internal. When an investment thesis fails, the financial loss can be measured, but the psychological loss is harder to quantify. It challenges self-perception. I thought I understood this. I believed I had insight. I told others this would work. The loss becomes personal. Neuroscientific research shows that the brain processes threats to self-image in regions associated with physical pain. Ego injury is not metaphorical discomfort. It is experienced as genuine distress. Admitting error intensifies that distress. Thus, the mind deploys defense systems. Cognitive dissonance in investing. One of the most powerful psychological mechanisms involved is cognitive dissonance. Cognitive dissonance occurs when new information conflicts with existing beliefs. The brain experiences tension and seeks resolution. In investing, dissonance appears when market outcomes contradict conviction. If you believe a company is fundamentally strong and its price collapses, you face two conflicting realities. I am competent. My decision is failing. Resolving the conflict can occur in two ways. 1. Adjust the belief, admit the mistake. 2. Adjust interpretation, reinterpret the evidence. Ego prefers the second. Instead of updating the thesis, investors often reinterpret data. The market is irrational. This is temporary volatility. They don't see the long-term vision. These statements may sometimes be correct, but the motivation matters. Are they grounded in new analysis, or are they shields against identity disruption? Confirmation bias as ego armor. Once ego is activated, confirmation bias intensifies. Investors begin seeking information that supports their existing view. Articles reinforcing the thesis are saved. Analysts who agree are cited. Contradictory evidence is dismissed as flawed. The environment becomes curated. Social media amplifies this effect. Online communities form around shared financial beliefs. Within these communities, dissent is often minimized. Reinforcement dominates. The investor becomes surrounded by affirmation. Affirmation reduces dissonance, but it increases blind spots. Ego protection does not eliminate information. It filters it. The illusion of rational persistence. There is a fine line between disciplined conviction and ego-driven persistence. Long-term investing often requires holding through volatility. Great investments sometimes appear wrong before they prove right. This creates ambiguity. How do you distinguish strategic patience from ego defense? The key question is, are you holding because evidence supports patience, or because exiting would feel humiliating? Ego defense is often disguised as resilience, but resilience is grounded in updated assessment. Ego defense is grounded in protecting identity. The two can look identical from the outside. Internally, they feel very different. Resilience feels steady. Ego defense feels tense. Public commitment and escalation. Ego protection intensifies when commitment is public. If an investor makes a prediction publicly, on social media, in interviews, among peers, that prediction becomes part of their reputation. If markets contradict the prediction, admitting error carries social cost. Reputation is status. Status is identity. Thus, public forecasters are often slower to reverse position, not necessarily because they believe more strongly, but because retreat feels like reputational erosion. Escalation of commitment follows. Instead of adjusting, they double down. More arguments, more data, more conviction. The original thesis becomes fortified. Ego is defending territory. The brain prefers consistency. Human beings value consistency. Consistency signals integrity. It signals stability. It signals reliability. Changing one's mind too often can feel like weakness. But in dynamic markets, inflexibility is risk. The brain's preference for consistency collides with the market's demand for adaptation. This tension produces internal friction. When faced with new evidence, the mind subconsciously weighs two losses: the financial loss of holding a weakening position, the psychological loss of admitting prior error. Often, the second feels heavier, because financial loss can be externalized. Ego loss feels internalized. Intelligence as defensive tool. Ironically, intelligence can amplify ego defense. Highly intelligent individuals possess strong analytical skills. When confronted with disconfirming evidence, they can generate complex counter-arguments. They reinterpret macro trends. They shift time horizons. They construct nuanced frameworks. These arguments may sound sophisticated, and sometimes they are valid. But intelligence becomes dangerous when it is deployed to defend identity rather than reassess reality. The smarter the investor, the more refined the rationalization. Ego does not fear data. It recruits it. Emotional investment beyond capital. Financial commitment is rarely purely financial. Time, energy, research, and emotional anticipation are invested alongside capital. The longer an investor studies a thesis, the more personal attachment develops. This attachment increases ego involvement. If the thesis collapses, not only money but effort feels wasted. The sunk cost fallacy begins to operate. I've spent too much time on this to abandon it now. But sunk costs are ego artifacts. They represent past identity investment. Letting go feels like invalidating previous self. Thus, ego prolongs exposure. The threat of incompetence. One of the deepest ego fears in investing is incompetence. Markets are competitive arenas. Performance signals intelligence. Returns signal capability. A failed investment can feel like evidence of inadequacy. Admitting error publicly may feel like confirming weakness. To avoid that conclusion, ego constructs defense narratives. It was unpredictable. No one saw this coming. It's manipulation. The system is flawed. Some of these explanations may contain truth, but their emotional function is protection. They prevent the self from internalizing incompetence. Ego and market volatility. During bull markets, ego expands. Profits reinforce competence. Confidence grows. Risk tolerance increases. During downturns, ego contracts defensively. Investors cling to narratives that preserve self-image. Volatility tests identity. Those who define themselves as always right suffer most. Those who define themselves as adaptive learners suffer less. Because flexibility reduces ego threat. The real danger. The danger of ego protection is not a single bad decision. It is accumulation. Small failures to update compound over time. Delayed exits magnify losses. Repeated rationalizations erode capital. Escalations amplify exposure. The market does not punish ego immediately. It punishes it gradually, and gradually feels survivable until it is not. The path forward. Ego is not the enemy. It is natural, but unchecked ego distorts perception. The goal is not eliminating pride. It is detaching pride from prediction accuracy. A resilient investor builds identity around adaptability rather than infallibility. Instead of saying, "I am right," they say, "I update." That subtle shift weakens ego defense. It reduces the pain of being wrong. And in markets, the ability to say, "I was wrong" early is often more profitable than being right eventually. Because ego resists correction. But markets reward correction. The investor who understands ego protection does not seek to destroy ego. They seek to observe it. When tension rises after new information emerges, pause. Ask, am I defending capital or am I defending myself? That question may be uncomfortable, but in investing, discomfort often precedes clarity, and clarity precedes survival. Section 3. Status, Pride, and Social Position. Money is rarely just money. It is signal. It signals competence. It signals intelligence. It signals discipline. It signals foresight. In markets, capital is currency, but status is the deeper economy. Financial decisions are not made in isolation. They are observed, discussed, compared, judged. And once observation enters the equation, status enters with it. Status shapes risk. Status shapes persistence. Status shapes the willingness or refusal to admit error. Markets as social hierarchies. Every financial environment contains a hierarchy. Top-performing investors are admired. Accurate forecasters gain influence. Early adopters of successful trends earn reputational capital. Portfolio returns become implicit scorecards of competence. In professional settings, hedge funds, venture capital, asset management, performance is explicitly tied to reputation. In social settings, peer groups, online communities, entrepreneurial circles, performance is tied to perceived sophistication. Returns become narrative ammunition. I saw this early. I understood the trend. I positioned before the crowd. These statements are not merely informational. They are status claims. Pride as psychological anchor. Pride is a powerful stabilizer of identity. When an investor publicly commits to a thesis and it succeeds, pride reinforces conviction. Confidence rises. Reputation strengthens. But when the thesis weakens, pride resists retreat. Selling may be financially logical, but psychologically humiliating, because it implies, I misjudged. I overestimated. I was wrong. Pride converts financial flexibility into reputational rigidity, and rigidity is expensive. Reputation risk versus financial risk. In many cases, investors fear reputational damage more than monetary loss. Consider institutional fund managers. Their performance is evaluated relative to peers. Underperforming alone is career-threatening. Underperforming with the crowd is survivable. This dynamic encourages alignment. If everyone allocates to a rising sector, not participating may risk relative underperformance. If the sector later collapses, shared error reduces individual blame. Collective mistake diffuses responsibility. Isolated mistake concentrates it. Thus, reputational risk can outweigh financial prudence. Social proof at the elite level. Herd behavior does not disappear at higher intellectual levels. It evolves. In elite financial circles, consensus forms through research conferences, private briefings, institutional memos, and peer discussions. When respected figures express conviction, dissent becomes more difficult. Challenging consensus in such environments is not merely analytical disagreement, it is social deviation. The higher the perceived status of those endorsing a view, the greater the psychological cost of contradicting it. Thus, even highly sophisticated investors may align with dominant narratives, not because they lack intelligence, but because status ecosystems shape incentives. Public identity and financial tribes. Financial identities often crystallize around philosophies: value investors, growth believers, macro strategists, crypto maximalists, real estate purists. Each tribe has norms. Belonging to a tribe provides intellectual community and psychological stability. It reinforces worldview. but it also constrains flexibility. If a value investor publicly criticizes growth stocks for years, then reallocates heavily toward them, the shift invites scrutiny. Is this conviction or capitulation? Fear of reputational inconsistency can slow rational adaptation. The social cost of reversal. Changing your mind privately is difficult. Changing it publicly is harder. Public reversal invites commentary. Why the change? What did you miss? Were you wrong before? These questions threaten status. Thus, investors sometimes persist longer than justified, not because they believe deeply, but because retreat feels socially costly. The irony is that markets do not reward consistency, they reward accuracy. Yet socially, consistency is often admired. This misalignment creates tension. Performance as identity. In competitive financial environments, performance becomes intertwined with self-worth. A strong year reinforces competence. A weak year threatens self-image. When returns define perceived intelligence, admitting error becomes a psychological threat. The more identity is fused with performance, the more defensive behavior intensifies. This dynamic explains why some investors double down during drawdowns. They are not just defending positions, they are defending perceived ability. Pride and escalation. Pride does not merely resist retreat, it escalates commitment. When challenged publicly, individuals may intensify conviction to signal strength. In debates, subtle shifts become bold declarations. Instead of acknowledging uncertainty, tone hardens, because uncertainty may be interpreted as weakness. Financial markets are full of such escalations. Bold predictions receive attention. Confident forecasts attract followers. Humility is quieter. Yet humility is often more accurate. The illusion of strength. Status-driven persistence can look like courage. Holding through volatility is sometimes disciplined. But holding through structural deterioration out of pride is not courage. It is ego defense in social form. True strength in markets is adaptability. But adaptability lacks spectacle. It does not generate applause, it generates survival. Comparative identity. Status is comparative. Investors measure themselves relative to peers. If peers profit from a speculative asset, abstaining may feel like falling behind, even if abstention is rational. Comparison intensifies during bull markets. Success stories circulate. Wealth becomes visible. Gains are highlighted. The absence of participation becomes conspicuous. Thus, investors may enter late-stage trends not because valuation is attractive, but because status comparison creates discomfort. The decision is socially motivated. Why status distorts risk perception? When status is at stake, risk perception shifts. A high-risk bet that aligns with consensus may feel safer than a moderate-risk bet that deviates from it, because consensus provides reputational cover. But risk does not disappear because it is shared. Shared exposure simply synchronizes outcomes. When the crowd falls together, individual reputations may survive, but capital does not. The professional trap. Professional investors face additional status pressures. Clients demand explanation. Media scrutinizes positioning. Rankings publish comparative results. In such an environment, reputation is fragile. The temptation to align with visible trends intensifies. Career preservation may conflict with long-term prudence. Thus, even those aware of identity economics may struggle to resist its pull. Status structures behavior. Reframing status. If status influences decision-making, the solution is not pretending it does not exist. It is redefining it. Instead of seeking status through prediction accuracy, seek status through intellectual honesty. Instead of signaling conviction, signal adaptability. Instead of equating confidence with strength, equate revision with discipline. The investor who can publicly say, "I reassessed and adjusted," signals a different form of strength. Quiet, durable, less theatrical, but more profitable. The hidden trade-off. Every financial decision contains two dimensions. 1. Capital outcome. 2. Social outcome. When these align, decisions feel easy. When they diverge, tension arises. Selling may preserve capital but weaken status. Holding may preserve status but threaten capital. Understanding this trade-off is essential, because once you recognize that status and pride shape behavior, you begin to see markets differently. Not as arenas of pure rational competition, but as stages of social positioning. And when you realize that many investors defend social standing more fiercely than financial exposure, a final question emerges. If status pressures are so powerful, how do sunk costs intensify attachment even further? That is where pride transforms into entrapment, and where identity becomes difficult to unwind. Section 4. The Sunk Cost Trap and Identity Lock-in. There is a moment in every failing investment when the logic is clear. The thesis has weakened. The competitive landscape has shifted. The macro environment has changed. The numbers no longer support the original conviction. And yet, instead of exiting, the investor says, "I've already come this far." That sentence is the doorway to the sunk cost trap. And when identity is involved, it becomes far more dangerous than a simple cognitive bias. What is the sunk cost trap? The sunk cost fallacy occurs when individuals continue investing time, money, or effort into a decision because of resources already committed, even when future prospects no longer justify continuation. Economically, sunk costs are irrelevant. They are gone. They cannot be recovered. Only future expected outcomes matter. But psychologically, sunk costs feel significant because they represent effort, commitment, time, belief, and often identity. From financial commitment to identity commitment. At the beginning of an investment, exposure is mostly financial. Over time, it becomes psychological. You research it, you discuss it, you defend it, you allocate more capital, you build narratives around it. Gradually, the position integrates into self-image. You are no longer simply holding the asset. You are associated with it. Your confidence in it becomes part of how you see yourself. This is identity lock-in. Exiting now is not merely cutting losses. It is dismantling a story you have been living inside. Escalation of commitment. When early signs of trouble appear, ego resists retreat. Instead of exiting, many investors increase exposure. This is known as escalation of commitment. I'll average down. The market is mispricing it. This is an opportunity, not a warning. Sometimes averaging down is rational, but often it is psychological defense. Additional capital becomes a statement. I still believe. The deeper the commitment, the harder it becomes to reverse. Because reversal would invalidate not only the initial decision, but every subsequent reinforcement. The emotional weight of time. Time intensifies attachment. If you have held an investment for years, you have woven it into your narrative. You may have told friends about it. You may have publicly advocated for it. You may have imagined future success through it. Letting go feels like abandoning a long-term relationship. The longer the holding period, the greater the psychological inertia. Time does not improve thesis validity, but it strengthens emotional bonds. Public defense and identity fusion. When positions are defended publicly, identity fusion accelerates. Imagine repeatedly explaining why an asset is undervalued, writing articles, posting analyses, debating critics. Each public defense strengthens association. The investment becomes not just a choice, but a stance. And stances are difficult to abandon. If you exit quietly, you face internal dissonance. If you exit publicly, you face social scrutiny. Thus, many prefer continued defense over admission of error. Pride amplifies sunk costs. Pride converts financial exposure into reputational exposure. If a significant portion of your credibility rests on a specific thesis, withdrawing feels like self-diminishment. The sunk cost becomes more than capital. It becomes pride. The cost of admitting error now includes perceived weakness. Thus, investors remain locked, even when evidence accumulates against them. Narrative reinforcement. The mind is a storyteller. When an investment weakens, the narrative adjusts. Temporary setbacks become buying opportunities. Structural shifts become short-term noise. Competitive threats become overblown fears. Each reinterpretation reduces dissonance, but increases lock-in. The more elaborate the narrative, the harder it is to unwind. Because unwinding requires admitting that the story was flawed. The illusion of future redemption. One powerful driver of sunk cost persistence is hope. If it just returns to my entry price, I'll exit. I'll wait until I break even. It will recover eventually. This mindset reframes the decision around past price rather than future probability. Break-even becomes psychological salvation. But markets do not care about entry points. Future outcomes are independent of personal history. Waiting for redemption is often ego preservation disguised as patience. Identity-based loss. Aversion. Loss aversion, the tendency to prefer avoiding losses over acquiring equivalent gains, is well documented in behavioral finance. But when identity is fused with position, loss aversion intensifies. The loss is not just financial, it is symbolic. Admitting loss may feel like admitting incompetence. Thus, investors hold losers longer than winners, because selling a winner confirms competence. Selling a loser challenges it. Intelligence as reinforcement. Highly intelligent investors are especially vulnerable to identity lock-in. Why? Because they can construct increasingly sophisticated justifications. They reinterpret macro indicators. They project alternative growth trajectories. They highlight overlooked catalysts. These arguments may sound persuasive, but their function may be defensive. The more complex the reasoning, the deeper the lock-in. Intelligence does not dissolve attachment. It often strengthens it when lock-in becomes structural. In extreme cases, identity lock-in becomes structural entrapment. Consider investors who have built careers around specific ideologies: perpetual bulls, perpetual bears, thematic specialists. Changing stance threatens brand. Thus, structural incentives reinforce sunk cost persistence. Reputation becomes collateral. At that stage, exit is not merely financial adjustment. It is professional redefinition. And that is rare. Breaking the trap. Escaping the sunk cost trap requires reframing. Instead of asking, "How much have I already invested?" ask, "If I did not own this today, would I buy it?" This simple question disconnects past from future. It dissolves sunk costs into irrelevance. It forces forward-looking analysis. But answering honestly requires ego tolerance. Because if the answer is no, then continuing to hold is identity-driven. Pre-commitment as protection. One powerful defense against identity lock-in is pre-commitment. Before entering a position, define what would invalidate the thesis. What metrics must remain intact? What events trigger exit? Writing these criteria in advance reduces emotional distortion later. It externalizes decision logic. When evidence contradicts criteria, exit becomes procedural rather than personal. Structure reduces ego involvement. Redefining identity. The deepest solution is identity restructuring. If identity is built around being right, sunk costs trap you. If identity is built around adapting quickly, exit becomes strength. Instead of defining self-worth through prediction accuracy, define it through learning velocity. Then admitting error enhances identity rather than threatening it. This inversion is transformative. The real cost. The true cost of the sunk cost trap is not a single bad investment. It is compounded rigidity. Each refusal to exit reinforces ego dominance over capital discipline. Over time, this pattern erodes wealth quietly. Markets reward those who adjust early. They punish those who defend past decisions longer than evidence justifies. The hard truth. Sunk costs are not financial anchors. They are psychological anchors. And when identity wraps around them, they become chains. Breaking those chains requires something counterintuitive: letting go of the need to justify the past. Because in markets, the future does not reward loyalty to previous conviction. It rewards clarity about present reality. And clarity demands detachment. Which brings us to the next layer. If investments become extensions of identity, how deeply does self-image shape portfolio construction itself? When does your portfolio stop reflecting strategy and start reflecting who you believe you are? Section 5. Financial decisions as self-image. At some point in every investor's journey, the portfolio stops being a collection of assets. It becomes a reflection, a mirror. not of markets, but of self-image. We like to believe that we choose investments based on objective evaluation, risk-return analysis, cash flow projections, macro outlook, competitive positioning. But beneath those frameworks lies a quieter force. Who do I believe I am? And what kind of investor does someone like me become? Financial decisions are rarely neutral. They are expressive. They communicate identity to others and to ourselves. The portfolio as personal narrative. Every investor carries a story. I am disciplined. I am bold. I am conservative. I am forward-thinking. I am skeptical. I am visionary. These identity statements influence asset selection. A self-described innovator may gravitate toward emerging technologies. A capital preserver may prefer tangible assets and defensive sectors. A macro thinker may build positions around geopolitical themes. The portfolio becomes narrative consistency in financial form. It confirms identity. If your self-image is built around foresight, you will prefer assets that allow you to feel early. If your self-image is built around prudence, you will prefer assets that signal caution. In this sense, portfolio allocation is not just capital strategy. It is self-expression. Tribal investing. Financial communities reinforce identity. Value investors share language and heroes. Growth investors form their own canon. Crypto believers cultivate narratives of decentralization and disruption. Real estate advocates emphasize tangible security. Within these tribes, certain behaviors signal belonging. Doubt may be discouraged. Loyalty may be rewarded. Conviction may be celebrated. When identity becomes tribal, deviation feels like betrayal. You are not merely reallocating capital. You are shifting allegiance. This makes flexibility difficult because tribes provide social stability, and humans value belonging more than optionality. Identity reinforcement through gains. When an investment aligned with identity succeeds, reinforcement intensifies. The growth investor sees confirmation of foresight. The conservative investor sees confirmation of prudence. The contrarian sees confirmation of independence. Profits do not just increase wealth. They strengthen self-concept. Success feels like validation of who you are. This creates positive feedback. The stronger the identity confirmation, the deeper the attachment to the strategy. When markets attack identity. Trouble emerges when markets contradict self-image. A cautious investor missing a speculative boom may feel outdated. A bold investor suffering repeated drawdowns may feel exposed. A macro strategist misjudging cycles may question competence. These contradictions create identity tension. Adjusting allocation becomes more than financial recalibration. It becomes narrative revision, and narrative revision is psychologically expensive. Thus, investors often resist change longer than evidence justifies, not because the evidence is unclear, but because change destabilizes identity. Financial debates as identity defense. Have you noticed how heated financial debates can become? Discussions about valuation, asset classes, or strategy often escalate quickly. That intensity reveals something important. Participants are not only defending analysis, they are defending identity. When someone criticizes your investment approach, it can feel like a personal critique. You're reckless. You're naive. You're outdated. You don't understand innovation. These interpretations may not be explicitly stated, but they are felt. An ego responds defensively. The debate becomes personal because self-image is implicated. Self-signaling in private. Identity does not only operate socially, it operates internally through self-signaling. You observe your own behavior and draw conclusions about yourself. If you hold through volatility, you reinforce the identity of resilience. If you sell early, you may interpret yourself as fearful. Thus, financial decisions become identity-building exercises. You are constantly answering implicitly, "What kind of investor am I?" This internal reinforcement strengthens consistency. But consistency can harden into rigidity. The performance identity trap. One of the most dangerous identity structures is performance-based self-worth. If you equate good returns with personal competence, volatility becomes identity threat. A losing streak feels like incompetence. A missed opportunity feels like failure. To protect identity, you may overtrade, overanalyze, overcommit. The goal shifts subtly from optimizing capital to restoring self-image. This shift is rarely conscious, but it is powerful. Intelligence and identity attachment. Highly analytical investors often develop identity around being intellectually rigorous. Their portfolios reflect complexity, multi-layered theses, sophisticated models. Admitting error may feel like undermining intellectual authority. Thus, identity-based attachment intensifies. The more intelligence is tied to strategy, the harder it is to abandon. Intellectual pride can become financial inertia. The danger of "I am my strategy." When identity fuses fully with investment style, flexibility collapses. If you define yourself as the long-term holder, you may ignore structural deterioration. If you define yourself as the aggressive early adopter, you may underestimate downside risk. Strategy becomes identity. Identity resists revision. Markets evolve. Identity may not. And when identity fails to evolve, capital suffers. Reconstructing self-image. The solution is not eliminating identity, it is redefining it. Instead of identifying as the one who is always right, the one who predicts correctly, the visionary, consider identifying as the one who adapts quickly, the one who updates when evidence changes, the disciplined probabilist. This subtle shift transforms decision-making. Now, changing course strengthens identity rather than threatening it. Admitting error becomes confirmation of discipline. Flexibility becomes pride. Portfolio as process, not personality. One of the healthiest reframes is viewing your portfolio as a process rather than a personality. Assets are tools. They are not extensions of self-worth. A declining position does not imply incompetence. It implies miscalibration. And miscalibration can be corrected. When you detach self-image from holdings, you regain objectivity. Exit becomes neutral. Reallocation becomes rational. Debate becomes analytical rather than defensive. The final insight. Financial decisions are rarely pure. They are entangled with self-concept. We choose assets that reflect who we believe we are. We defend them because abandoning them feels like abandoning identity. And until we recognize this dynamic, we will continue believing we are optimizing wealth when we may be protecting self-image. True financial maturity requires a quiet internal revolution. You are not your portfolio. You are not your thesis. You are not your past decision. You are the process by which you update. When identity becomes flexible, capital becomes freer. And when self-image is no longer fused with positions, financial decisions regain clarity. Which leads us to the next question. If intelligence often strengthens ego defense, why do smart people stay wrong longer than others? And how does sophistication become a trap? Section 6. Why smart people stay wrong. There is a comforting myth in finance. The smarter you are, the less likely you are to make costly mistakes. Reality is more complicated. Intelligence does not eliminate bias, it refines it. In fact, smart people often stay wrong longer than average investors, not because they lack data, but because they possess something more dangerous: the ability to defend themselves convincingly. Intelligence as a defensive weapon. When an investment thesis weakens, every investor faces tension, but highly intelligent individuals experience a particular advantage and disadvantage. They can construct more sophisticated justifications. They can reinterpret macroeconomic signals. They can refine valuation frameworks. They can adjust time horizons. They can reference historical analogies. These explanations often sound rational, and sometimes they are. But intelligence allows ego defense to become elegant. Instead of simply denying reality, smart investors rationalize it. They do not say, "I refuse to admit error." They say, "The market is mispricing long-term value." The distinction is subtle. The outcome may not be. Overconfidence and cognitive precision. Research in behavioral finance repeatedly shows that intelligence correlates with overconfidence. When individuals possess strong analytical skills, they trust their conclusions deeply. Confidence is reinforced by prior success. If past predictions proved correct, future ones feel reliable. This confidence increases position size. It increases conviction. It decreases willingness to adjust. Overconfidence does not feel reckless. It feels earned. But markets punish certainty, and overconfidence reduces flexibility. The expert trap. Experts face an additional vulnerability: reputation. Once someone is known as an authority on a specific sector, theme, or strategy, deviation becomes costly. If a recognized technology analyst suddenly abandons a long-held bullish view, credibility may be questioned. Thus, experts may cling to positions longer than justified, not because they lack awareness, but because retreat undermines authority. The public identity of expertise becomes constraint. Complexity as camouflage. Smart investors often build complex mental models. They incorporate macro trends, liquidity conditions, behavioral factors, and competitive positioning. Complexity enhances analysis, but it can also obscure error. When a thesis is simple, flaws are visible quickly. When a thesis is complex, it can absorb contradictory data. Small inconsistencies are reframed as secondary variables. Negative signals are contextualized. Weaknesses are labeled temporary distortions. Complexity becomes camouflage. And the more intricate the framework, the harder it is to dismantle. The illusion of superior insight. Highly analytical individuals often believe they understand more than the market. Sometimes they do, but markets aggregate dispersed information. If price persistently contradicts thesis, humility may be required. Smart investors may resist humility. They may interpret market disagreement as market ignorance. If I see it, eventually others will. This belief may occasionally be correct, but it can also prolong error. The line between conviction and stubbornness narrows as intelligence rises. Intelligence and identity fusion. When identity is built around being intellectually superior, admitting error becomes existential threat. If your self-image is, "I see what others miss," then market contradiction challenges that narrative. The temptation is to preserve the narrative, to reinterpret events in ways that maintain superiority. But markets do not reward self-consistency. They reward probabilistic accuracy. The sunk cost of analysis. Smart investors often invest significant time researching positions, reading reports, building models, engaging in debates. This research deepens attachment. The more effort invested in analysis, the harder it is to accept that analysis may have been flawed. Abandoning the position feels like invalidating the work. Thus, intelligence amplifies sunk cost attachment. Time spent analyzing becomes part of identity commitment. Narrative sophistication. When facing loss, less experienced investors may simply panic. Smart investors do something different. They build narratives, nuanced explanations, multi-layered arguments, historical comparisons. These narratives may sound convincing. They may persuade others. They may even persuade the investor. But persuasion does not guarantee correctness. Narrative sophistication can mask cognitive rigidity, selective adaptation. Interestingly, smart investors often update partially. They adjust small elements of the thesis while preserving the core. We were early. The timing was off. The catalyst was delayed. The structural thesis remains intact. Partial updating reduces dissonance without full admission of error. This can be adaptive, but it can also delay necessary exit. The mind preserves identity while appearing flexible. Ego and public forecasting. Public forecasters face unique challenges. If predictions are documented, articles, interviews, posts, reversal becomes visible. The Internet preserves history. Admitting error publicly requires ego strength. Some do it. Many avoid it. Instead, they double down. They reinterpret signals. They project further into the future. They widen uncertainty bands. The original thesis morphs rather than dissolves. Intelligence without humility. Intelligence becomes dangerous when not paired with humility. Humility does not mean insecurity. It means recognizing that markets are probabilistic systems. No model captures everything. No thesis is permanent. No expertise guarantees accuracy. The smartest investors understand this deeply. They detach ego from being right. They focus on adapting faster than others. Without humility, intelligence hardens. With humility, intelligence evolves. The paradox of expertise. Expertise is necessary in finance. Understanding valuation, risk, and macro context is essential. But expertise must remain flexible. When expertise becomes identity, flexibility collapses. When expertise becomes tool, flexibility survives. The difference lies in attachment. Are you defending knowledge or deploying it? The hidden strength of simplicity. Sometimes simpler investors exit earlier. They rely on fewer variables. When price breaks thesis, they act. They may lack complex justification, but they possess practical detachment. This detachment can outperform brilliance trapped by ego. Staying wrong versus updating early. Markets reward early correction. Small losses preserved become capital available for new opportunities. Large losses defended become structural setbacks. The difference often lies not in intelligence, but in ego calibration. Smart investors who stay wrong too long often do so because intelligence is serving identity rather than adaptation. The ultimate discipline. The ultimate discipline is not predicting correctly. It is updating without resistance. It is saying, my analysis was incomplete, without perceiving that statement as personal failure. That shift transforms intelligence from defense mechanism into adaptive advantage. And once intelligence is paired with ego discipline, something powerful emerges. The ability to detach identity from capital entirely, which leads to the final section. If ego, status, sunk costs, and intelligence all distort financial decisions, how do we build an investor identity that is resilient rather than fragile? How do we protect capital without protecting pride? That is where true financial maturity begins. Section 7. Detaching identity from capital. If identity shapes incentives, ego protects narrative, pride reinforces persistence, sunk costs, anchor commitment, and intelligence refines rationalization, then the central question becomes unavoidable. How do you separate who you are from what you own? Because as long as identity and capital are fused, objectivity will remain fragile. Detaching identity from capital is not emotional suppression. It is structural clarity, the core shift, from being right to updating fast. Most investors define success as accuracy. I was right, but markets are probabilistic systems. Being right consistently is unrealistic. What matters is not perfection, but correction. The identity shift begins here. From I am the one who predicts correctly to I am the one who adapts quickly. This shift sounds subtle. It is not. If identity is tied to prediction, admitting error threatens self-worth. If identity is tied to adaptability, admitting error reinforces it. Now saying, I was wrong, becomes proof of discipline, and discipline compounds. Build identity around process, not outcome. Outcomes are volatile. Process is controllable. If you define yourself by returns, your identity fluctuates with market cycles. If you define yourself by decision quality, you preserve stability. Ask, did I follow my criteria? Did I evaluate evidence honestly? Did I update when conditions changed? This reframing detaches ego from short-term price movement. Capital performance becomes feedback, not verdict. Pre-commitment as ego shield. One of the most powerful tools for detachment is pre-commitment. Before entering a position, write, what conditions would invalidate this thesis? What metrics must remain intact? What would cause me to reduce exposure? By defining exit criteria in advance, you reduce identity distortion later. When evidence contradicts your thesis, exit becomes procedural, not personal. You are not admitting weakness. You are executing protocol. Structure weakens ego interference. Separate public identity from portfolio. Public positioning intensifies attachment. If you constantly broadcast your views, identity fuses with them. Detachment requires selective silence. Not every conviction must be public. Not every thesis must be defended. When views remain flexible, reputation pressure decreases. You gain space to adjust quietly. This is not about secrecy, it is about reducing ego exposure. Reframe loss. Loss is not indictment, it is tuition. Every investor pays tuition. The only difference between successful and unsuccessful investors is whether tuition buys learning. When you detach identity from capital, losses become informational. They are signals about model calibration, not proof of incompetence. This reframing dissolves shame. Without shame, adaptation accelerates. Practice mental substitution. A powerful detachment exercise. Imagine you do not own the asset. Given current information, would you initiate the position today? If the answer is no, continuing to hold is identity-driven. This mental reset severs sunk cost bias. It returns focus to forward probability. Build anti-ego rituals. Detachment is not automatic. It requires habit. Some effective anti-ego rituals include conducting quarterly thesis audits, writing postmortems on losing positions, inviting dissenting opinions intentionally, tracking prediction accuracy transparently, setting maximum position size rules. Each ritual reduces ego dominance. Each reinforces humility. Humility is not weakness. It is structural strength. Redefine strength. Markets often glorify conviction, but conviction without flexibility becomes fragility. True strength in investing is not stubbornness. It is composure under revision. The investor who calmly adjusts exposure does not appear dramatic. But drama is not profitable. Consistency of process is. The emotional discipline of letting go. Letting go is psychologically difficult. It requires admitting that past effort does not justify future exposure. It requires tolerating temporary embarrassment. It requires prioritizing capital over pride. But each time you exit rationally, detachment strengthens. Each correction reduces ego's grip. Over time, detachment becomes identity. You are no longer defending positions, you are managing probability. Identity reconstructed. Ultimately, detaching identity from capital does not mean becoming emotionless. It means reconstructing identity around qualities that survive volatility: curiosity, humility, adaptability, probabilistic thinking, risk management. When these traits define self-image, capital decisions become clearer. Losses do not wound identity, they refine it. The final liberation. Markets will test you repeatedly. They will reward you unpredictably. They will contradict you publicly. They will tempt you socially. If identity remains fused with capital, each test becomes personal. But if identity is anchored in learning and discipline, each test becomes informational. Detachment is not apathy. It is clarity. It is the quiet ability to say, "This thesis no longer fits reality," without perceiving that statement as self-diminishment. Because in markets, survival belongs not to the most confident, but to the most adaptable. And once identity is no longer chained to capital, something powerful happens. Decisions become cleaner. Risk becomes calibrated. Loss becomes tolerable. And wealth, free from ego distortion, begins to compound. We do not defend investments. We defend ourselves. The investor who understands this no longer fights the market. They observe themselves. And that awareness becomes their edge.